Hi, good day to you all, students. So today in this video, we will be talking about analysis and interpretation. So analysis and interpretation all about graphs, graphs, percentages, values, So when is the time we will do analysis and interpretation? So this happens when companies have just produced their financial statements for the year ending, say, 2024. So in the year 2025, around January the time, the company top managements will be sitting down together and review the past 1 year's performances. All will have kind of ratios, percentages, and we make comparison with the past years. So because why? We want to know how good are we? We want to know how strong is our position in the market compared to the others, or comparing ourselves to ourselves in the past few years back. And so we can establish a trend, whether we are going up or our performance is going down. So normally, this will be followed by AGM, Annual General Meeting. During Annual General Meeting, company will be sitting down together with all the shareholders and other relevant interested parties in a setting. It's like an event, and probably you as one of the chief accountant will be asked to do the presentation on PowerPoints in front of everybody, and explaining, giving insight about how is your company performances for the past 1 year, and what are your future plans. Are you okay now? Are you steady in the market? What are your 5 years down the road plan to do? And what will be the expected returns that all shareholders and all interested parties should expect? So what are the things that we analyze? Well, to be honest, there are many ratios out there. So in year 10 or year 11, you'll be learning quite a few. And later on in university and colleges timing, you'll be learning even much more than that. And so you have to be able to interpret, what is this about? What does this percentage tells me? What does this ratio tells us? You have to talk about that. So generally, we have 3 types of ratios out there. So the first one, the first one will be the profitability ratios. Profitability ratios shows our profit. Its name already suggests that. How good is our profit? How are we managing our income? How are we managing our sales? How are we managing our expenses? Because if you still remember, our income statement will be as such. Sales minus cost of sales equals to GP, your gross profit. You plus other income minus all the other expenses, daily and your non-operational ones. Then you minus off with your interest and loans. Then you get your profit or loss. So around here, you'll be having your profit from operations. Then you get profit or loss for the year. Still remember your income statement, guys? Be good at it, yeah? So analysis and interpretation chapter could test on sole proprietor or your limited companies chapter. Now, the first ratio on the profitability will be our gross margin. Or sometimes they call it the GPM, the gross profit margin or gross margin. Its formula is the gross profit comparing to our sales revenue. Margin will always be, and normally referring to our sales, our revenue, that's the margin. And you multiply by 100, then you get a percentage value later on. So it shows how much of gross profit that you've got for every $100 of sales that you've made. So it's basically talking about how good are you in managing your sales. That's all. Secondly, we have the profit margin. Sometimes they call it the NPM because net profit. This portion also sometimes they call it the net profit or the net loss. So profit margin. So it takes the profit for the year comparing with the sales or the revenue. Sometimes the sales, they call it as sales revenue, or sometimes very rare you hear it as turnover. So profit margin talks about how good is your profit for every $100 of revenue that you earn. How much profit you got? The net profit, which means it will be talking about how good are you in managing your expenses. Because before your profit comes, you have lots of expenses to go. So gross profit margin takes gross profit comparing to sales. And profit margin talks about how is your profit that you got when compared to the sales. For example, our sales is $100 or 100%. You minus off your cost of sales, let's say 20, you get 80. You plus extra income, let's say another 50, then you get you get 130. So 130, you minus off your expenses, let's say 70, your expenses. So what is left? 130 minus 70, you get a 60. And 60 minus off a small interest portion, you get 50. So if we talk about gross profit margin, 80 over 100, then you get a 80%. And profit margin, you take this compared to the sales, you get a 50. Okay? So then there is something called the markup. Markup is a technique to get your selling price. It's a price setting technique, in which later on in your university level, you'll be having this topic called the target costing or target sales price chapter. Okay, so how does this work? The name shows already. Mark up. You mark up your price. You hike up your price. Of course, whenever we buy something, this is our cost of sales. We buy at the lowest price possible. Let's say $100. Let's call this 100%. We mark up by another, let's say 50%, and so our selling price will be 150%. $150. Let's use dollars. Yeah, 100 would be very easy to talk about. So this is actually your desired profit, as in your desired gross profit, though. Your desired gross profit margin. Yeah, it's like another way around, right? If you look at it, your selling price is higher. So like, if let's say this is your cost of sales, right? Is your cost is 20. You hike up your profit by 80, then you get 100 there. That kind of feeling. So markup is a technique. Okay. Then we also have the percentage of expense to revenue. This is an expense control measurement to see how good are you in managing your expenses. Normally, they will take the gross profit margin percentage minus off the profit margin percentage. And so the lower, the better. Okay. For all the past, okay, GPM, the higher the better. Profit margin, the higher the better. Okay, mark up the higher the better, but really depends. Okay, there will be all kinds of debating questions later on as you go through your journey. Okay, the 5 marks question for each 20 marks question in your paper 2. Okay, there's no right, no wrong answers though. Give 2 advantage and give 2 disadvantage on whether to hike up the price. So you give your own common sense understanding. If you hike up your price, what will happen? You get more profit. Okay, you will not be worrying about your financial distress situation. However, in the hindsight, okay, the disadvantage will be customer may go to your competitor who sells at a cheaper price. And secondly, since the first disadvantage happens, and so your sales will be affected. So what should you do? Should you hike up the price or you should go down the price? Well, up to you. You can just give either one, right? Because there's no right or wrong in business. Remember that. There's no right or wrong. It's always you try, you get your feedback, whether it's a good thing or bad thing. Then after that, you revise everything and try again. It's always a try again thing in the business. There's no right, no wrong, seriously. Okay? Yeah. Now, and for expense, percentage of expenses to revenue must be the lower the better. Right? Now, the last one is, okay, return on capital employed. Means for every $100 of capital that you employ, you inject into the business, how much of return that you will be getting back? Yeah. So this is the so-called ROCE. Well, to be honest, there's much more, even more than that in your university later. There's only 5 things for profitability for year 10, year 11. Normally, if we, let's say, just follow the accounting cycle and the syllabus wise and the arrangement that is, I feel, deemed the right arrangement, normally this chapter, you will be facing them after your financial statements adjustments. Somewhere between end of year 10 and beginning of year 11, you'll be touching these chapters. Okay, so return on capital employed is given with the formula of PBI. Okay, PBI, profit. Okay, let's make it the full ones. Yeah, profit before interest. So meaning they're talking about profit from operations. That is your PBI. Because before interest, here's the interest that you deducted. So this is before interest and this is after interest. Now in university, you'll be getting different names of your profit. It will really mean is PBIT because after that you'll be deducting with your interest and you get PBT, your tax. Before tax. And after that, there's another one more. You deduct the tax and you get your PAT after tax. That's university level. So remember, the things that you learn in year 10, year 11 is much alike. The basics is there. However, when you go for the further education, you see some slight differences and even advanced and even more than that. Okay? Now, profit before interest divided by capital employed times 100 and you get a percentage at the end of the day. Okay, what is capital employed is given by a few formulas. It's your capital plus your non-current liability. Okay, your SOFP over here. It's your NCA, CA, C, NCL, CL. This portion. Okay, your SOFP, yeah. Here. And we'll be also having our NCA plus CA and minusing off your current liability. This one plus and minusing this off, then the leftover portion is this. And we also sometimes given as capital employed in the beginning of the year, okay, brought down, plus capital employed at the end of the year, and then you divide them by 2. All right. Now the screen is a little bit laggy, so allow me to make some adjustments. Okay, it's fine. And we also have issued shares plus reserves and plus the non-current liability. Okay, this part will be the ones that coming from limited liability companies chapter, limited companies. Okay, because this issued shares and reserve is part of the capital. So this is capital employed, right? So this is your profitability ratios. Okay, the next one will be our liquidity ratio. Liquid, very liquid, huh? Liquidity ratios, in which they are talking about your money. Our money flows like water, don't you think so? Whenever when we are talking about cash, we get money, cash for sales of a product, money comes in fast. And after that, when we pay something with cash, money goes out, just like that, like pipe water. You open the pipe water, go down. That is liquid. Money is our liquid, just like water. Water is the main life stream. Without water, I don't think we can survive. So like in life here, when it comes to money, when we don't have money, well, they say money is not important, but everything needs money. Can you buy something without money? No. That's how this world works. So now, liquidity ratio has 2 parts here. There's 2 things here that we'll be learning. Okay, the first ratio is called current ratios. Current ratio. Sometimes they call it as the working capital ratio. So this is where we take current assets comparing with current liability. So it measures what? It measures your ability to pay debts when they fall due. What kind of debts? That you need to pay within 1 year. Current liability, do we all see here? Current liabilities, remember? Yeah. For every $1 of liability, how much of asset do you have that you can pay off? So the best ratio, normally, there's no good or bad ratio, but the normally accepted ones is considered okay, is 2 current asset portion to 1 current liability. Normally this is good. Meaning for every $1 of liability, you have $2 in your hand to pay off that $1, and so you have $1 with you left. That is your current ratio. Okay, to pay debts when they are needed to pay within the 1 year. The second one is even, harsh man, this is called the liquid, or sometimes they call it the asset pass ratio, or quick ratio. I want it to be quick. How? All right, the entire current asset, I want to throw away the closing inventory. It's like I pour an asset on your inventory, and I want to see, can you pay me right now on the spot? Quick. I want you to pay the money quick today, now. I don't want you to wait for the next coming few years, 1 year time, or the coming few months time, because current liability is about 1 year. But let's say you just imagine this: your trade payables, your supplier, one of them suddenly come to your shop. That fella pour an acid, a very concentrated one. Let's say sulfuric acid, H2SO4. They throw all your closing inventory, all everything, acid, burn, melt. So I want to test. Do you still have money to pay me back? I'll show you an example later on. So again, the best one is sometimes they say it's a 0.7 to 1 to 1. It's okay. Okay, so there's no hard and fast rule though. It's just that we are scared if you have too much current asset in your hand, right? You have too much cash in your hand. It's not only, well, you have too much cash in your hand, it will mean 2 things. One, on the good side, is that you are financially stable. You're able to pay expenses when they are needed. You're okay, you're doing fine. However, to some people, all right, especially investors, they say you have too much cash in your hand, meaning you're not doing something productive. Because cash, if you have too much cash in your hand, means you do not know how to invest. Life hits hard. We are taught to be saving person, but we are also needed to be taught on how to make investment. Cash, if you have excess cash in your hand, you should make investment so that cash brings cash. Well, that's business, guys. So too much money in your hand may not be a good thing. So let's give you an example, yeah? Okay, so my current asset, I have inventory. Let's say I have 50,000 of inventory word in my hands. Okay, I have trade receivables who are owing me, say, 30,000. And in my bank, I have 2,000, and my cash in hand is only 500. Okay, bank, let's make it 20,000. Yeah. Okay, and then my current liability is trade payables. I am owing people how much? Let's say 60,000. Now, if we talk about current ratio, then I'll be super fine. You see how much I have in my current asset in total. 50 plus 30 plus 20. I got 100,000 and 500. Divide by 60,000. So it's a 1.675. Okay, let's make it 1.68 to 1. Okay, quite okay. Yeah. But if we go for the liquid ratio or the quick ratio, what will be happening? The total of current asset that we have here is 100,000 and 500, right? And I minus off the inventory. Are we able to pay these 60,000 of trade payables? If let's say that particular supplier come to our shop and ask for the money immediately, you'll be like, oops, you see how much you have. If let's say on the spot, if I only have 20,500, 30,000 is stuck in my customers. I need to go and ask the money from them to give me now. I need to go and force them. If let's say my trade payables suddenly come up today, tough life. So 100,000 and 500 minus off 50,000. I will only have like what, 50 and 500 divided by 60k. Okay, I barely surviving. 0.84 to 1. Barely surviving. I'm not enough money. And some more, the trade receivables is quite stuck my money there. My money is also stuck in my closing inventory. I need to sell them off. Please give me some time. No, I don't want to give you time. I want my money today, 60,000. Gone. Barely enough to pay off the 60,000. If let's say now at this spot, I only can give you 20,500. Yeah. And then I need to call all my trade receivables to pay the money back because some supplier is very demanding and is like running amok in my place. Okay, so this is the differences between the current ratio and your quick ratio. Okay, money. This is a part of your cash portion. And the last one, we will talk about efficiency. How efficient are you in dealing with people? Efficiency ratio. Okay, so one of them is the rate of inventory turnover. This is nice, man. Why? How good are you in selling things? Basically, that's what they're talking about. Okay, we have two formulas here. If they are asking about how many times, it will be this. Okay, cost of sales divided by your average inventory. How many times will it be? How to remember this? If they ask for times, well, meow, CAT. C over A and you get T, CAT, meow. Now, average inventory is opening inventory plus closing inventory, and then you divided them all by 2, average inventory. So, if the number of times is higher, means it's good. Meaning, on average, within a year, you have replenished your stock by, let's say, 10 times. So, wow, you replenish your stock by 10 times means you are good in selling, man. On average, within 1 year, you've already restocked a lot of times. Like, whoa, good sales team. Good marketing strategy. Now, there's another one more formula, or depends. Then you go switch it off, switch it around. Okay, it will be average inventory over cost of sales multiplied by 365 days. If they want for days, you give 365. If they want in months, then you give 12 months. If they want in weeks, you give 52 weeks. If they want in days, you multiply by 7. Okay, so I mean days. Weeks. Then you multiply by 7. Okay, the 7 days. There's okay, sorry. We have days. We use 365. If it is a month, then we use 12 months. 12 months or weeks. Yeah, weeks. Only these 3. Sorry. So, how many days, how many months, or how many weeks you take to replenish your stock on average? If the lower, the better. So means in on average, you have took how many days in total for you to replenish your stock once. Okay, so it's like if let's say you get answers such as like 20 days, it will mean that every 20 days you replenish your stock one time. So so the lower the better. So meaning the lower last year you took 20 days to replenish your stock once. This year is average 15 days you take to sell off all your things, then you replenish your stock one time. That is rate of inventory turnover. How good are you in selling your products? Okay, because you do not want to have very high closing inventory. You want to make it just balanced, just nice. Although closing inventory, if it is higher, your gross profit will be higher because it helps reduce your cost of sales. So inventory for the closing part, closing inventory is a bit of a controversial. It's like a bit of a dilemma in accounting. Yeah, because it will really affect your gross profit. If you not believe it, you can do some experiment over your income statement here. You can do some changes and testings. Okay, your variable will be your cost of sales, the closing inventory in particular. Secondly, okay, this will be the trade receivables turnover, whereby they say it will be our trade receivables over the credit sales multiplied by day, months, or weeks. Let's use the days then. And again, the lower the better. Why? On average, it will take you a number of days for you to get the money from your credit customers. So it will show how long it will take for customers to give you money to pay their invoices. So how good are you in managing customers? How good are you in collecting the debts from your customers? Do you give monthly statement of accounts to remind your customers their balances? How good are you in maybe like caring for your customers? How are they doing? That kind of thing. Yeah. So that is for trade receivables. Also, the other way around, we also have our trade payables turnover, meaning how long it will take us on average for us to pay our supplier for our invoice, for our debts that we owe to our suppliers. So the formula will be also the same, just different name. It will be trade payable over credit purchases. Be careful, yeah? They are talking about credit purchases, not the cash portion. Same goes for the sales. So that's all these three types of main ratio in analysis and interpretation chapters. And till then, I'll see you all again in our next coming video. Okay, bye.